Why it is so important to understand financial statements? Tell me. I am CA Latika Lala. I have 6 years of corporate experience. And I have seen people around me who doesn't have any idea about the financial statement, which I think is a basic skill everyone should have so that they can use it into a different parameters of their life. I also feel that some people know some parts of the financial statement, but they have never fully understood it because of its complicated jargon. So in today's video, we will be covering the balance sheet part of the financial statement. And I am 100% sure if you stay till the end, you will gonna understand fully and will be able to read any balance sheet of any company. For every question, there are two extremely important things. The why part of the question and the how part of the question. Let's first focus on the why part of the question. Why you should know how to read financial statements. It can help you to manage your money in a better way. For example, if you earn 10,000 rupees per month, you paid 2,000 for your credit card bills, another 4,000 for your expenses, and the 2,000 goes to the EMI. So you save every month 2,000 rupees. If you know how to read financial, you will be able to understand which expenses most needed one and which expenses are the utterly waste one, which can help you to make a better decisions so that you can save more money. So once you started saving more money, you have to invest that money somewhere. So if you know how to read financials, it can help you to invest in a better place. So the probability of getting into fraud is less. The probability of getting into any chit fund is also less. So that is why it is so important for you to understand on how to read financial statement. Let's go and see on how to read balance sheet. I hope now you understood the why portion of the question. Now let's go and understand how to read a financial statement in a simple manner. Any financial report is basically divided into three parts. One is your P&L statement, which is called as profit and loss statement. The other one is your balance sheet statement. And the third one is your cash flow statement. Today, we will be focusing on the balance sheet statement. We use many products in our day-to-day lives, such as Dove, Lakme, Maggi, Nescafe. Do you know which companies own these products? These are HUL and Nestle. And I'm pretty sure once you are done with this video, you will be able to understand the balance sheet of these companies, which products you are using on day-to-day basis. So in today's video, we will be taking balance sheet of Reliance Industries for our understanding purpose. So you can download the balance sheet or annual report of Reliance Industries from the Google Chrome just to understand on how the balance sheet works. The balance sheet is firstly divided into two parts, the asset side and the liability sides. The asset sides, what the company owns. The liability sides, to whom the company has to pay. In simple terms, asset means for us it is like a saving, investment. Anything which we own, our mobile phone, our house. And for us, the liabilities are the credit card bills, the EMI. In the same manner, asset what company owns and liability was to whom the company has to pay. I hope you are clear with the asset side and the liability sides. Let's go more deeper. Now, these two things are further divided into two sub-parts, which is the short term and the long term. So the asset is also divided into a short-term assets and the long-term assets, whereas the liability is also divided as a short-term liabilities and the long-term liabilities. Now, what does short-term and long-term means? Short-term basically means which have a tenure less than 1 year, and long-term basically means which have a tenure of more than 1 year. Short-term also known as the current, whereas the long-term is also known as a non-current. So liabilities and asset are also divided into two: current asset, non-current asset, which is short-term, long-term asset, and non-current liabilities and current liabilities, which is the long-term liabilities and the short-term liabilities. So I hope you are clear with me till now. Now let's move to the asset side of the balance sheet. So the first part is the non-current asset. So non-current asset generally comprises of the property, plant, equipment, which is the building, machinery the company uses to produce the product, the loan which they have given to any other people, which they will recover in more than 1 year, or goodwill, or any intangible asset. It is classified in the non-current asset part of the balance sheet. I hope you remember the definition of the asset and the liability part. So it's asset means what company owns and the liability means what company has to pay. So now you have seen the non-current asset part. For owning that property, plant and equipment, the company might have taken some portion in the form of a loan and some they have paid it from their own pocket. For taking that loan, it is classified on the liability side of the non-current. So if you see, there is a long-term borrowing. So this is used for buying that property, plant and equipment. And that's how it is interlinked. So non-current asset is mostly interlinked with the non-current liability parts. They might also have taken some buildings which is present in the non-current asset part on lease, which will also be presented in the non-current liability side. Now the second part is the current asset. The current asset, which means the tenure of less than 1 year. So if you can see, the current asset is further bifurcated into inventories, where as on 31st March, the company hold this much of inventory, which they will gonna sell it out in the next year. The trade receivables, the company has already sold the goods to the customer, but the customer is yet to pay. That is presented in the trade receivables. Now it is part of the current asset because the tenure is less than 1 year, because they will be receiving that money from the customer within 1 year. Cash and bank balance, investments in mutual fund, and any other which the tenure is less than 1 year is presented in the current asset. Now on the current liability part, they might be used some portion of the loan to fund this inventories. So there will be the current borrowing, the working capital borrowing the company uses to fund the inventories. The creditors, to whom the company have bought the raw materials, they are yet to pay back the money to the supplier. So that is present in the current liability part. So now I hope you understood about the non-current asset, current liability and the long-term liabilities. But if you see, there is one more portion on the liability side, which is the net worth part. Net worth part is further divided into two things, the share capitals and the retained earnings. The share capital amount is the amount which the promoter, during the start of the business, they have invested that money in the business. And the retained earning, for example, if the company has started 10 years back, so every year there will be a profit. That has been added in the retained earning part. So the total of share capital plus retained earning is known as the net worth. I will summarize for you. Firstly, balance sheet is as on date, as on any particular date. For us, it is as on 31st March 2025. It is divided into two parts, the asset side and the liability side. They are also further divided into two parts, the current asset, non-current asset, current liability and non-current liability. Current means the tenure is less than 1 year. Non-current means the tenure is more than 1 year. Okay. So now let's see the few findings from the balance sheet. Now you will say that current asset should always be equal to the current liability. No, that is not true. The current asset will never be equal to the current liability, because the current assets includes the inventory, the trade receivable, the cash and bank balance, etc. Whereas the current liability includes the borrowings, working capital, the current maturities of the long-term borrowing, and the trade payables. So it won't be equal because there are some portion of the inventories or the working capital requirement the company has funded from their own resources, the profit which they have earned during that particular year. So hence, they will not always take a loan from the bank to fund the working capital requirement. Sometimes they uses their own funds to fund the working capital requirement, and for the remaining amount, they go to the bank and ask for the money. So the current asset will never be equal to the current liability. And it is always says that it should be the ratio of the current assets to current liability should be more than 1. There is one more popular ratio known as debt to equity ratio, where we include the total debt which the company owns, we divide it with the net worth of the company, and we see that how much the requirement of the company is funded through debt and through the net worth. Net worth is basically, which I have told you earlier, that it is the promoters which have infused funds during the start of the business and the profit which they have accumulated over the years. So in this ratio, we see that how the company is dependent on the debt and how much it is funding the requirement through the own sources. There are many other ratios which is used to do the analysis of the balance sheet, which we will be learn in the upcoming videos. That's it for today, but I have one task for you guys before going. It's to download any balance sheet, any annual report of any company which you love, and just try to understand the balance sheet part and put down your learnings in the comment so the others can also learn and grow from you. Thank you. In the next video, we will be covering the profit and loss account of the financial analysis part. Till then, stay tuned, subscribe to my channel, and thank you for watching this video. Bye bye.